In 2023, the average home equity line of credit balance was over $42,000. That was up 2.7% from last year. And with rising home values, you might be thinking about taking that money and using it to fund projects, pay down debt, or just use it as an emergency reserve. Unfortunately, whenever money is easily available, that could lead to disaster and a ton of financial regret. But if used properly, having a home equity line of credit can be a super powerful tool. But the first step is to know the different parts of a HELOC loan or a home equity line of credit. Now, a HELOC versus an equity loan is the same in the sense that you're taking a loan on the equity in your property. The big difference is the equity loan is a set amount where the HELOC acts like a credit card. The equity loan you would take out for a set amount of money for a specific purpose, whereas the HELOC you have a lot more flexibility. A HELOC will have a set max amount on the loan, but it starts with a zero balance. If you never use the HELOC, you will never have to make any payments. As a matter of fact, when you get a HELOC loan, typically a bank will actually give you a physical credit card to withdraw those funds. You'll have a draw period. Typically, it's about 10 years where you can withdraw from the HELOC. During that time, only interest is due. And then at the end of the draw period, you have your repayment period. And that varies depending on the loan. Usually it's anywhere between 10, 15 years on that repayment, and your principal and interest is due at that pay period. You cannot withdraw once you enter the repayment period, so you have only 10 years to withdraw that money to take advantage of that HELOC. And then on interest rates, equity line of credit, typically you'll get a fixed rate mortgage, but on a HELOC, it is variable. And the variable interest rate is going to be based on whatever the Federal Reserve prime plus or minus whatever's in your loan terms. So if you wait 2 or 3 or 4 years, the federal rate goes up, that interest rate's going to go up on your HELOC. It could go down the other way as well, but it absolutely is much harder to budget on a rate that is variable versus a rate that is fixed. Okay, so now you know the basics of a HELOC. Let's get into regret number 1, which is not understanding the terms fully. Some banks will offer a discounted rate as an intro period. If you withdraw money right away, they will give you that discounted rate for an extended period of time, or it could be the life of the loan, but you want to read the fine print and you want to know exactly what is the loan repayment, what is the rate requirements on that loan. But the bank rate, which is either plus or minus the Fed rate, is locked in. So you might have prime minus 0.5%. That 0.5% is going to stay regardless of what that prime rate is. You also want to look at exactly what the draw period and the repayment period is. Those can vary. A typical draw period is about 10 years, but it could vary between 5 and 15. And then the repayment is typically up to 20 years, but you want to know exactly what that period of time is, because that is how you're going to figure out what those monthly payments are going to be. The other thing you want to look out for are balloon payments. Sometimes you'll have a draw period, and at the end of that draw period, the entire amount is due right away, and that's called a balloon payment. And the last thing you want to look out for is understanding the fees and the penalties. If you have a monthly fee on your HELOC loan, that is regardless of whether you use it or not. So you could have a HELOC loan that's just maybe there for a reserve, but it's still costing you $5, $10, $15 a month or more just as a service fee. So you want to make sure you understand what exactly the service fees are. You also want to understand what it costs to actually open the HELOC, what the upfront closing costs are, and you also want to look at prepayment penalties. Is there a fee or penalty if you pay it off early? Say you get a big chunk of money from the IRS and you want to put it towards your equity loan to pay it off. Are they going to stick you with a penalty because you're paying that off early? You want to make sure there's no prepayment penalties. Now, the second regret is over borrowing. Say, for example, you want to go on that vacation. You work really hard. You deserve it. You say, I never take vacations. I have access to this money. It's going to come out of my equity. When I sell the house, it'll get paid back, right? Well, if you have a $10,000 vacation or a $10,000 bathroom update or whatnot around the house, you take that $10,000, you have a HELOC that's based on prime. Right now at the filming of this video, prime is 8.5%. And if it's a 30-year payment period, now you have a little thing called amortization. And what amortization does, it's all about compound interest. You get charged interest on your principal on whatever you pay. And then the following payment, it's a little bit more and a little bit more. $10,000, and I'm including a calculator in the description down below so you can check this out yourself. But a $10,000 withdrawal on a HELOC, if that's all you do is $10,000, by the time you get done paying that back, it's just under $30,000. Your $10,000 vacation just cost you 30 grand. And yes, it'll get paid back when you sell the house, 100%. But it's going to get paid back $30,000 that you're going to miss in that equity when you sell. The other thing that could happen is underestimating home projects. You don't do enough research. You think the kitchen's going to cost you $50,000, so you get a HELOC for $100,000 just because you can. You have the available home equity. If you don't spend it, it doesn't cost you anything, so why not? We'll get the $100,000. Well, that $50,000 now starts to turn into 60 or 70 because you realize that the cabinets actually cost a little bit more now than they did maybe a year ago because of inflation, or you decide to upgrade a little bit. You've got a little extra money on your HELOC, why not? So you decide to upgrade. Or you decide to say, oh, I might as well, since I've got everything ripped out, might as well replace some of the plumbing, or the list goes on. And that project could balloon. Whenever you're estimating a project, you always want to do 1.5 times. Trust me on this. To do 1.5 times, if you think it's going to cost you 50, you want to budget for 75 just to be on the safe side. If it costs you less, great, but you want to be careful of that underestimating on the projects. Another thing you want to watch out for is unplanned or non-essential projects or purchases. Say, for example, you open the HELOC with the intention of renovating your kitchen. At the same time, you're saying, gosh, my mattress is 20 years old. I need a new mattress. Mattresses are expensive. I get that. However, now you're saying, I have this available money, I can go get it, and I'll have a new mattress next week. Next thing you know, you're at the furniture store buying a $2,000 or $3,000 mattress, and now you've just added that to that equity loan. Super, super dangerous. And then that can lead to using it for day-to-day purchases outside your budget. If you have a budget and it is set and it covers all your expenses, but now you want to start maybe using it for something a little extra. I made this mistake myself back in 2005, bought a condo in New Hampshire as a second home. My family, we like to ski, we love the mountains. The justification was that we were going to use it, we were going to rent it when we weren't there, use the money from our equity as our down payment, and then proceeded to withdraw money with a HELOC to improve the property. Our justification was that, of course, we would be improving the overall market value of the property because we were improving it. However, we did anticipate the market crashing. Market values plummeted and we lost our shirt. And we had to sell it at a short sale because of the fact that the value of the property did not cover the equity loan. Now, part of the process of getting a HELOC or a home equity loan is knowing what your current market value is. And a great resource to get that information is to consult with your local real estate agent. Now, although a lender will go through an official appraisal process, it's nice to know what that current market value is before you start the process during your budgeting period. Now, I have been practicing real estate since 1996, and over the years, I have built relationships with thousands of real estate agents across the country. If you need a referral for an agent in your area, there is a link down in the description. Click the link, fill out the short form. I'll get in touch with you myself. We'll have a short conversation so that I can match you with the best agent in your area that will take great care of you and give you that market value information that you need. Now, the third regret is going to be not considering alternatives. I mentioned earlier the home equity loan. If you have a certain project that you need a set amount of money, then a home equity loan might be a better option. It'll be a lower fixed interest rate, and it will be a set amount. Now, you can absolutely fall into that temptation of overborrowing if you have a project and say the project is going to be $30,000 and you say, you know what, let's get $60,000 instead. Now you have $60,000 cash because when you get a home equity loan, they're going to deposit that money right into your bank account. And now that money can actually go into your checking account and all of a sudden start making mortgage payments and grocery bills and whatnot. So you still have to manage, but it's a fixed amount of money and it's a fixed payment. So the payments can be budgeted, you know exactly how much it's going to cost. So that might be an option. Another option would be a personal loan. And the advantages of a personal loan is you don't have a lien on your property. If you, for some reason, default on your personal loan, they cannot use your home as collateral. If you default on an equity loan is considered another mortgage on the property. And just like any other mortgage, if you don't make the payments, they could foreclose on the property. They could take the property as collateral. If you do a personal loan, they can't come to you for your property. Another option might be a cash out refinance. Now, you might be sitting on a low interest rate and this may not make sense for you if you have a 2.75, 3.5% interest rate, and a refinance would get you back up to 7% or more. However, it might make sense depending on your circumstances. You have to look at the sum of the parts to see if this works for you. But when a cash out refi, you would refinance the mortgage. You only have one mortgage and then pull out money at the same time. So if you owe $100,000 and you do a cash out refinance for $150,000, now that $100,000 mortgage, that old mortgage is paid, so you have a new mortgage in its place, and then that leftover $50,000 comes to you at the closing in the form of cash. So you're refinancing, now you have one mortgage of $150,000. There's no equity loan, it's just the one mortgage. You do lose that rate, but it might make sense depending on what your situation is, it might be a good fit for you. And then the last option, if you're over the age of 62, is to look at reverse mortgages. And in very plain terms, a reverse mortgage is essentially taking the cash from your home and pulling it out in lump sum payments or regular monthly payments with no repayment period unless the borrower moves or passes away. So this is a very, very common scenario. If you're over 62 years old and you're maybe struggling on Social Security, a lot of homeowners will take advantage of this because you can actually take that money out. If you're living in the same home for a long period of time, you have a lot of equity built up, you can use that to ease the burden of trying to live, and especially right now with a high inflation society, that could absolutely reduce the burden of just everyday living expenses. Now, the reverse mortgage, there's a lot of other things to consider when you're going down that path, and I would absolutely urge you to do as much investigation as you can on that to see if it's a good fit, but it could be another alternative or a better alternative depending on your situation to a HELOC. So now you know about the major regrets. How do you avoid those and not become one of those people that says, oh my gosh, I wish I never did this? The first thing is you've got to do your homework and you got to shop around. We're so fortunate in this day and age to have an unlimited supply of information at our fingertips. You can research rates, terms, special intro rates, all the fine print you can research online. It's all available through every bank at your fingertips, so you can do a side-by-side comparison to see which one makes the most sense for your situation. The other thing I would absolutely urge you to do is consult with a financial advisor. If you have a financial advisor, I would pick up the phone and have a conversation. You want to find out if that's something that makes sense. They may say, you know what, HELOC doesn't make sense for your situation. A home equity loan makes better sense. So consulting with a financial advisor that knows the story of where you sit with your finances is absolutely a great way to protect yourself from making those wrong decisions. The other thing you can do is to create a detailed budget. Now, I get it. Budget is like a 4-letter word. It's not exciting and it feels constraining. Just the term budget has negative connotations, but it's a really good tool to keep you in check and to really give you an overview of your financial picture. You start tracking everything you spend. The other thing you can do is only borrow what you need. If you have a specific project that you want the money for, yes, you're going to budget a little bit higher than what you think, but only use it for that purpose. If you have a home equity line of credit for reserves, I personally have a HELOC for exactly that reason. I'm a single mom and I'm self-employed. And God forbid I get sick, something happens to me. I want to make sure my kids are taken care of, my family's taken care of, that I can pay the bills. So I have a HELOC for emergency purposes only. I shopped around. I found a HELOC program that has no monthly fees. So it costs me nothing to have this just sitting there. And I will not use that unless it's a dire emergency. And I don't touch it. I'm not going to borrow because it's not what I got the HELOC for. I got it for emergencies. I'm only going to use it if it's an absolute emergency. So sticking to a plan and borrowing what you need is crucial. And then lastly, consider all your options. If after you have looked at your financial picture, maybe you talked to your financial advisor, you look closely at your budget, even though a HELOC is a terrific way to leverage your equity in the right way, the best plan might be to not do anything. Maybe another mortgage payment just doesn't fit in your budget, and it's best to hold off, wait until you get a little bit more financially secure to be able to make those payments, then take advantage of your equity. Now, the most common way of using a home equity loan is for renovations. But sometimes those renovations don't go according to plan, and they lead to renovation regret. If you're interested in learning more about that, check out this video. I'm Jen Sylvester, and I'm here to help you be a savvy home seller.